Oscar Health just had one of the craziest trading days I've seen, from 10% swing low in pre-market to 10% swing high and closing at a massive 8% on the day. They had preliminary financial results for their second quarter of this year, and they revised guidance. In this video, we're going to be going over that, and we're going to be going over my updated high five snapshot, and we'll get into the charts a little bit later. So let's get into it, guys. So just going over first, Oscar Health announces preliminary financial results for second quarter of 2025 and revises 2025 guidance. The leading healthcare technology company announced today certain preliminary financial results for the second quarter ended June 30th, 2025, and updated full year guidance of 2025. The company actually expects a net loss for operations of approximately $230 million and a net loss of approximately $228 million for the second quarter of 2025, being reported August 7th. The pre-announcement is driven by a review of 2025 marketplace data, second quarter risk adjustment reports from Wakely. So basically, they were, basically had no choice but to come out with this information and let everybody know, because Wakely was going to report that and let that information out. An independent actuarial firm that analyzes paid claim submissions through April 30th. The individual market is a competitive healthcare marketplace that provides affordable, high-quality coverage for millions of consumers across the country, said Mark Bertolini, CEO of Oscar Health. We are taking appropriate pricing actions for 2026 that reflect higher acuity in the individual market, and we will continue to take steps to deliver for our members, partners, and shareholders. Oscar has successfully navigated the dynamic markets before, and we remain committed to our long-term strategy to bring more employees, individuals, and families healthcare choices that fit their needs through the individual markets. So great statement there by Mark Bertolini. And I really like this part about pricing actions for 2026. We'll get into the reason why we dropped and then we rebounded here in a little bit, guys. The analysts of the second quarter risk adjustment reports, covering nearly 100% of Oscar's geographic footprint, shows that overall ACA marketplace risk scores, a measure of average morbidity of the market, have increased by more than the company's prior estimates. Based on the reports, the company now expects a medical loss ratio of 86 to 87% for full year 2025. Utilization by Oscar members remained elevated in the second quarter of 2025. However, cost trends moderated as compared to the first quarter of 2025. The revised guidance assumes risk adjusted as a percentage of direct and assumed policy premiums is largest consistent year over year, and that elevated trends observed in market risk scores and recent company utilization patterns persist for the remainder of 2025. The company expects to resubmit rate filings for 2026 in states covering approximately 98% of current membership to reflect the higher market risk scores by ACA. So essentially, what you need to know here is that typically, on average, the medical loss ratio, or MLR, is about 80%. What we have seen recently is that it has actually spiked to a high of 86 to 87% for Oscar. It spiked up to about 84 or 85% for United Health Group, which is the leader in this sector, in the health insurance sector. And Centene, they've actually spiked to 88 to 89% MLR score. So this isn't just a Oscar specific issue. This is an issue across medical health, or across health insurance companies, where they're seeing this unexpected spike in medical loss ratio. But the biggest thing here is that SG&A expense ratio stayed between 17.1 and 17.6%. So they actually have continuously brought that down, because in 2023 and 2024, it's been right around 18 to 19% SG&A costs. And basically, they're now at 17.1 to 17.6%, even with this higher medical loss ratio. And what this basically means is that Oscar this year is going to have a loss of on the EPS side. So basically, what this means is Oscar was going to report a 60-some cent earnings per share this year, and they're actually now going to report more than likely a loss on earnings per share, barring some miraculous miracle. But we're going to get into why that is a negative catalyst, but we're going to get into why this stock is actually up 8% and why I'm even more bullish now than I was before. Okay. So moving on into the rest of this, we can see that they're expecting 300 to 200 million loss. The company expects an adjusted EBITDA loss approximately 120 million, less than loss of operations. And if we look down here, this little diagram, they actually increased their full year 2025 outlook to 12 to 12.2 billion dollars in revenue. Analysts in their previous guidance expected 11 point some billion dollars in revenue. So they've actually increased revenue by $1 billion. And if you want to know how much revenue growth that is actually for this company, that is 30 to 32% year over year revenue growth. And that is why Oscar Health is up 8% right now today, because they had a massive 30% plus revenue growth guidance. And there's not many companies out there that are growing revenues 30% plus year over year. And this has been one of my bull theses around Oscar Health, is the fact that I do believe that they could grow revenues 20 to 30% plus in that range for the next 5 to 10 years. This is a company that is increasingly growing with ICRA and ACA. And even though ACA subsidies are going away, possibly if they're not renewed before the September of this year, essentially, then we could easily see this company growing 20 to 30% per year for the foreseeable future for the next 5 to 10 years as they continue to take market share, as they focus on customers and they focus on having good reviews and they focus on having loyal customers that love their product with the AI integrations and the leadership. And who better to lead this company than Mark Bertolini, as we already know, as we covered in previous videos. I'll link those above and down in the description. Some of his interviews, my reactions on him and him as a person. I truly believe he is a great leader for this company. He actually came out of retirement to lead this company, and there's just so many bullish catalysts for this company to continue to take market share from bigger competitors like Centene and United Health Group. So, with all this being said, what are my thoughts on this news? Well, when I first heard the news, I knee-jerk reaction said, man, that's not good at all. Why? Because they had pegged out 0.60 some percent from 0.10%, basically a 500 and some percent increase year over year in earnings per share. And now that has completely been wiped away. So I was instantly looking and saying, man, why did this happen? Right? Was this Oscar's fault? Was this the leadership's fault? And then once I dug a little bit deeper and I realized that UNH and Centene and this sector has had this explosion in medical loss ratio, you quickly realize that this isn't an Oscar issue. This isn't a leadership issue. This is a healthcare sector issue. Just like ACA and the big beautiful bill and all this negative fear, uncertainty, and doubt around this company and around this sector, it's a health insurance issue with politics, right? But what I will say to that is that we've seen Centene and so many other health insurance companies come out and strictly pull guidance for 2025 and 2020, or they haven't gave guidance for 2026 yet, but they pulled guidance for 2025 and they came out like Centene and completely crapped the bed in their last quarter. Now, you're not going to get a double beat out of Oscar. They've come out early and said they're going to have a negative EPS this quarter and a negative EPS for the year. But what I do know is the simple fact that they are going to do 30 to 32% revenue growth year over year. And they're not going to be profitable because of it, but because of MLRs, medical loss ratio. And that's a sector issue, not an Oscar issue. Like so many other things, people keep on saying Oscar's a crap company and they're not going anywhere and they're never going to make it in this sector. But time and time again, we see Oscar doing a lot better than its competition in this sector. And yes, they're going to miss on EPS, but they're going to massively beat on revenue. And again, 30% plus revenue growth. Now, this company has gone from, man, it's so undervalued on an EPS basis and a free cash flow basis and a price and a PE ratio and a PEG ratio. They're undervalued everywhere. Now it's really become, and why they're up 8% today, now it's become, oh, wait a minute. Everybody else is running scared in this sector. Everybody else is pulling guidance and saying, oh, woe is us, the big beautiful bill. Oh, woe is us, ACA subsidies going away. And Oscar comes out and raises guidance by $1 billion from 11 to 12 to $12.2 billion. Are you kidding me? Are you kidding me? While everybody else is running away scared, Oscar's out here gaining more business, more revenue. Yes, I understand that EPS is going to be negative. I understand that sucks, but free cash flow isn't going to be negative, and they're going to continue to have great free cash flow. So, knowing that, and knowing now that Oscar is a growth story, and it's going to take, and we'll get into my high five snapshot here in a minute. Basically, what I believe is going to be just a 1 year delay on that EPS coming back to positive, and a 1 year delay on that EPS coming back with a massive, massive growth story where we could see 50 cents to 60 cents next year in positive EPS. And then we're right back to being EPS positive and very underrated based on that. So we will get into that here in a minute. But if you don't, I wanted to show you guys this. So as you can see, Oscar Health, 86 to 87%. MLR ratio, Centene went to 88 to 88.5%. And United Health Group did about 85%. So you can obviously see that across the board, we just have a quarter, and in this year in general, MLRs, medical loss ratios, are just kind of getting a little bit out of control. But what Oscar's been able to do, as we just talked about, they've been able to continue to bring down that SG&A cost and those expenses. So they're bringing those costs down while, yes, being EPS negative now, they're bringing those costs down, and it's going to bolster future EPS scores, right? Or future EPS uh, numbers essentially. So if we come back over here, we are going to get into my high five snapshot. And like I'm saying, overall, if I had to give my honest review of what just happened today, I would say that it has made me more bullish because I was kind of beating the numbers up over here on the revenue growth side, but them coming out and being able to do 30% plus revenue growth this year, and knowing that Mark Bertolini has said that they're going to do 14 billion plus, and that's like him being very conservative, 14 billion in revenue in 2027, with everybody thinking, and even me having like a down year next year in 2026 on revenue, but knowing that 2027, that he's saying that they're going to do 14 billion in revenue and 5% net margins. So you would have a massive explosion in EPS in 2026 back to profitability. And then in 2027, a massive explosion upward with a 5% net margin, which their margins are like, around 2% right now. So absolutely massive. So I actually am more bullish because this shows this is a growth company, a massive growth company. And I have these numbers in here of, high single digits to teens, and they could be doing something crazy. Like, let's say next year is a down year, and then we get back to 20% plus growth. We get up to 22% there, and then we just continue to do just crazy numbers, 25% growth, 20% growth. You can see that massively with our free cash flow margin, $108 fair value on this company with a discounted cash flow model. It can really get that crazy, guys. So with a growth company like this, if you look out to 2026, like I said, this year should see negative EPS of 600% or whatever, and then next year we should rebound with a basically going from negative 50 to 50 cents once we get this MLR issue. So the pendulum swings with the MLR, medical loss ratio. It goes get really high, which is really, really high right now. And then it could get back and go back to the reversion. It can mean revert back to average. The average MLR is 80%, guys. So we are very extreme right now at 87 to 88%, right? And we will pendulum swing back eventually down to 80%. So they are also, like Mark Bertolini said, they are looking at 2026. They are adjusting things in every state that they cover to make sure that this isn't an issue going forward, to make sure they do come in and hit EPS next year, and to make sure this isn't like some spinning out of this company and they just continue to be net losers on EPS, right? And, again, it all comes back to having this type of CEO and trusting in him and believing that, he's a man of his word and, just understanding that he took Aetna from, he basically 5x Aetna stock price. So he is a amazing CEO, whatever you're going to say. He's an amazing CEO. He's proven himself time and time again. And again, you don't have the accolades that he has without proving that time and time again and being that good of a CEO and being where he's at now. So, Oscar Health, how does this change things? Well, on a discounted cash flow model with conservative numbers in here still, and going based off these updated numbers, we're at a $65 fair value on the discounted cash flow model. And again, we're at $14.72 today at close, a little less than $4 billion market cap. So essentially, it doesn't change much on the discounted cash flow model side of things. They're still pulling in around 1 billion in free cash flow. Now, if you take out the expenses that come with being an insurance company, then we get to probably around 500 million in free cash flow. But again, that doesn't matter that much because our margin rate over our current margin rate is about 11 or 12%. And I have in here a 5% margin rate on the free cash flow side for the next 5 years. So 6% lower than where we are right now. And I have us only getting to 10% in the last 5 years, just being very conservative here, guys. And again, we're at 11 to 12% now. Right now, we're at 11, 12% on the free cash flow margin rate. And I have them, doing only 10% last 5 years of 10-year analysis and 5% for the first 5 years of 10-year analysis. So if we actually put in what they're doing now, so say 11, they're doing 11% now. And then let's say they can get the 15% free cash flow margin rate. You see, we jump up to $101 instead of $65 per share. So again, you have to realize I'm not throwing in super rosy assumptions. I'm not sitting here saying that they're going to grow 20 to 30% per year. I'm not sitting here and giving them their current free cash flow margin rate. I'm doing a lot of things to beat this company up on my high five snapshot to sit here and make sure that even when I beat it up and say worst case scenario, everything goes to heck, they're still undervalued. They're still a great buy today. And that is another reason you saw them jump 8% off those $12 lows, right? $12 and some change lows, because it was just it's so ridiculously undervalued down there for a 30% revenue growth company year over year. How many companies do you know out there that are just absolutely killing it? They're growing 20% plus revenue growth and they have a PE on them of like 100 and some, or, they're not EPS positive, but they're free cash flow positive and they're just crushing it and people want to be in that stock. There's no difference here. 30% revenue growth is 30% revenue growth, guys. So on the EPS side things, it does change a lot. We don't know what 2026 is going to bring. I do believe they would be able to get back to at least 50 cents per share EPS with better MLRs, better medical loss ratios, but also, moving prices around and adjusting things for 2026 to make sure that they offset if this MLR does continue to climb, which I don't think it will, or if they do see it being, staying at 87 to 88% or 86 to 87%. If it doesn't stay there, based on them raising prices and stuff in 2026 and adjusting these things, I do believe that they can get to 50 cents in 2026 and 90 cents in 2027. And that brings them up to, for 2027, a fair value of $22.50 based on 90-cent EPS. And again, going out with a 15 PE, getting into the back half of this 10-year analysis and pretty conservative EPS growth rates. Again, we have a 10-year price target of $47-ish with a 12% annual CAGR. Not as great as discounted cash flow model. Again, I'm being very conservative here because I don't know how much. I don't know what the EPS numbers are going to look like. I think this is very conservative though, and I think them they're going to do 60 some cents this year, and that got derailed by MLRs coming out of nowhere and spiking, which again, it's a sector issue, not an Oscar issue. And because of that, I do believe that they can actually do probably, easily 60 cents next year to a dollar in EPS. It's just going to, I just want to be conservative, more conservative than, get crazy on here. I don't want to get crazy on here, and rather be conservative and, you know, still think this name's undervalued. But with 50 cents next year, and they were supposed to do 60 cents this year, with 50 cents next year, that's the fair value is $12.50 right now. So understanding that, you see, that we were down to like $12 and some cents there, and you realize that, oh man, like, yeah, that's really undervalued. How can we go beneath $12.50? That's our fair value if they only do 50 cents next year, and they were about to do 60 some cents this year. And it's all because of MLRs. So again, I still have a buy overall on this name, a buy on the discounted cash flow model, a buy based on the annual EPS model. And yeah, this hasn't wavered me at all. I did look into it. I made sure that I just I took my time with it. I knee jerk reacted a little bit, and you know, then ran in and got, I was like, oh man, that's not good. And then, I just did some due diligence, looked into everything, looked at the other sectors, looked at the other companies like Centene and UNH, saw what they were reporting, see what they did with their earnings, and how their MLRs are impacting them, and just realized that this again is a sector issue. The healthcare sector is very weak right now, and at the end of the day, it's Oscar's up 8% on the day when they just said that they were going to be let's just look at this, right? Oscar Health has had analyst after analyst after analyst after analyst come out and downgrade the stock consistently. Maybe they knew this was coming. This exact thing was coming, right? But they had all those analysts downgrade. Then they kept on getting smacked down in the price target, or the price kept on getting, basically just collapsing from, since we were at $22, just collapsing because Centene and other health insurance companies pulled guidance and reported bad. And then they come out and they actually up the revenue. And the reason they're EPS negative and they're going to lose money is not because of them, but because of sector issues with medical loss ratios increasing. So they've had analysts come in and like basically every single one of them downgrade them, like one after another after another. They crack down lower consistently due to other companies' guidance, other companies' earnings calls, right? And then they actually come out and say, yeah, we actually do have a little bit of bad news here. We're not going to be net income positive for this quarter. We got this issue here because of medical loss ratios. This is what we're going to do to counteract that in 2026. But hey, guess what? We actually made $1 billion more in revenue this year, and we're going to do over 30% revenue growth this year. How do you like them apples to everybody else that's pulling guidance and decreasing revenue and EPS? So you just have to take it for what it is. This company has been absolutely beat up since 22, and they came out with a mixed bag, right? I would call this a mixed bag. Being EPS negative is not a good thing, but then doing 30% plus revenue growth and saying we're actually going to do $1 billion more in revenue when there's all these ACA fears and everything, it's actually pretty bullish on that side of things. So definitely a mixed bag, but I see this company, continuously becoming more becoming more money to the bottom line, growing their EPS. Yes, it's not going to be this year, but next year it will. So it's basically, I think it's going to be a 1-year delay on that massive EPS growth that we're going to see in this company, while they're going to continue to be free cash flow positive, and they're increasing their revenue from 11 billion to 12 billion this year. And we still don't know what's going to happen next year, right? That's obviously a toss up. We don't know what's going to happen next year, but they brought out this bad news, and they said 2026 they're going to fix the prices, and they've done this time and time again. They've walked the walk, they've talked the talk before, and they're going to continue to navigate these markets. So I mean, you gotta sit here and say, okay, I see you, Oscar. I see you, leadership team. Like, you guys have actually done really, really well. You're growing revenues while everybody else is decreasing revenues by $1 billion. You're growing 30% plus on the revenue side. Okay, I can wait. I can wait one more year for EPS to be nice and rosy because I know the free cash flow is there. I know the leadership's amazing, and I know this company's going places. And I do believe they're going to be growing 20% plus as far as the eye can see. I think they're going to be eating everybody's lunch because they're focused on the customer service side. They're focused on taking care of people, and people want to be taken care of. We know this. I like being taken care of when I'm sick. I like knowing that you're like I'm going to be taken care of and I'm going to get the treatment I need. When United Health Group and all these other companies just continuously deny everybody claims over and over and over again, or they refuse people health insurance, or they refuse their claims, people get ticked off. And that's exactly why the average score, like their review is like around 0. And then Oscar's over here with a 66 NPS. They're basically their review score, like their reviews on Google. 66 compared to everybody else's average of 0. So they're going after customer service. They have AI. They're built on Amazon Web Services, while all the competition is built on rickety old .com age stuff, dial up. Okay, so yeah, look, I'm gonna do what I'm gonna do with this company. I'm gonna keep buying more. I'm bullish for the long term. Long term meaning more than a week, more than a day, more than a month, more than a year. I'm looking to be invested in Oscar for 3, 5, 10 years. And I'm not going to be selling out until the valuation gets a little crazy or my thesis changes. This doesn't change my thesis today at all. It doesn't change my thesis. So I'm going to continue to buy Oscar. I'm going to continue to hold for the long term. It's your money. You're going to do with it what you will. This isn't financial advice. I don't come on here to tell you what to do with your money, just like you shouldn't go in the comments and tell me what to do with my money. We're all grown adults, and we're all going to do what we're going to do. I have a track record of finding these types of companies, the Teslas, the Palantirs, the Nvidias, the HIMs, staying true to my conviction, to who I am, knowing my skills to be able to evaluate a company, understand where they're going, see the story, and having the high five snapshot to back me up and to understand the fundamentals beyond the high five snapshot, right? It's a snapshot for a reason. It gives us a snapshot of what to look for in a company if they're undervalued or not, and what we should be paying, how much margin of safety are we getting, what are the other metrics telling us, right? I'm confident in my abilities and myself. You don't have to be confident in me. That's okay. But I will continue to prove myself on the grandest of stages, like I have in the past. Just wasn't on social media. It's all good. But hey, guys, if you like this video, do me a favor, drop a like, drop a subscribe. I'll post my other videos here at the end of this so you can check those out. My other Oscar videos. I did a 5-minute video on Oscar, just briefly going over the fundamentals, the company, the overview, all that kind of good jazz. But I appreciate all of you being here to the end of the video. I love you all. Hope you have a great rest of your week, and I'll catch you in the next one.